Want to tell you something I wish someone have told me when I was making $200,000 a year, maxing out my 401k, and I still could not figure out why I felt significantly stuck. I was doing everything right. I was checking every box in the financial textbook told me to check, and I had no accessible cash, no liquidity, no way to act on an opportunity without triggering a penalty, risking my house, or waiting for a loan approval. The feeling has a name, the high earners wealth trap, and it is more common than you think. In this video, I'm going to show you exactly how it happens, what nobody tells you about it, and what changed everything when I finally understood how money actually flows and whose banking system I had been funding all along. Here is what the high earners financial picture typically looks like. First, high income, six figures, sometimes multiple six figures. Income is not the problem. You solve the income problem. Second, the 401k is max, $23,000 per year into a pre-tax account, watching the balance grow from $100,000 to $200,000 to $400,000. This feels like progress, and by some measure it is. Third, responsible debt management. Mortgage is on track, no revolving credit card debt, living inside the income. By every textbook definition, you are doing the right thing. And then the fourth line item, accessible capital, zero. Every dollar of your net worth is tracked. The 401k has a penalty gate. The home equity requires putting your primary residence at risk. The saving buffer is 3 to 6 months of expenses. It is your emergency fund, not your investment fund. You are not broke. You are liquid poor with a large illiquid balance sheet. And that distinction matters enormously the moment an opportunity shows up. Because opportunities do not wait for 401k distribution, they do not wait for bank approval, they show up. And if you cannot act, they move on. Let me show you exactly where the money is and what it costs to get to it. Log 1, the 401k. Early access before age 59 and a half triggers a 10% penalty plus ordinary income tax. In the 37% bracket, this is 47 cents gone before you invest $1. To net $150,000 for a down payment on a rental property, you would need to withdraw over $283,000. The math is catastrophic. Log 2, the home equity. You have equity in your home, but accessing it means a HELOC or a cash-out refinance, putting your primary residence at risk as collateral for an investment. If the deal goes sideways, you could lose both. Most rational people do not pull this trigger. Log 3, the savings buffer. Your savings account earns 1 to 2%. You keep 3 to 6 months of expenses there for emergencies. That is its job. It cannot also be your opportunity capital. 3 logs, no accessible capital, and no one in the financial system has an incentive to tell you there is a third vehicle, because the financial system benefits from you keeping your money exactly where it is. Here are the 3 things I wish I had understood before I maxed my 401k for 6 years. Insight 1, your cash value is not the loan source. When you take a loan against a property structure IBC policy, the money does not come out of your cash value. It comes from the insurance company's general account. Your cash value stays fully intact, earning its guaranteed rate, receiving its dividends the entire time the loan is outstanding. Your money is working in 2 places at once. That is not marketing language. That is the contractual mechanism. Insight 2, the design ratio changes everything. Most people think whole life insurance is whole life insurance. It is not. A traditionally structured policy with 100% in base whole life generates in general $871 in year 1 cash value on a $25,000 annual premium. An IBC optimized policy directing 90% to the paid-up additions rider generates $21,609 on the same premium. Same dollar, same insured, the design is the variable. Inside 3, this is a banking system, not a product. The IBC policy is not something you buy and file away. It is a system you operate. You fund it, you borrow against it, you repay it, you redeploy it, and with every cycle, the accessible capital grows. Nobody teaches this because nobody in the conventional financial world has an incentive to. Let me tell you what the first year looks like. The real estate deal that walked by last year, the duplex you could not act on is available again. This time, the down payment comes from a policy loan approved in days. No credit application, no penalty. The cash value keeps growing while the loan is outstanding. The business investment you have been postponing, the equipment upgrade, the marketing hire, the expansion your practice needed is now funded from the same source. But here is the thing most clients tell us that surprises them most. It is not the deal that changes first. It is the mindset. When you have accessible capital that is simultaneously growing, the scarcity that drives most financial decisions begins to dissolve. You stop saying no by default. You start asking whether the opportunity fits. That shift from constraint to clarity happens faster than the numbers do, and it is permanent.
I want to share the story of a client who came to us in year 7 of his career. He was 41 years old, a physician, household income over $400,000. He had maxed his 401k for 7 years. His balance was $620,000. His financial advisor called it a success story. He called it a trap because he could not buy the medical office building his practice needed. The bank wanted 30% down payment. His accountant told him not to touch the 401k, and his equity was tied up in his primary home. He had $620,000 in retirement savings and zero accessible capital for a real estate investment that would have changed his practice economics permanently. We helped him structure an IBC policy. He made consistent premium payments for 3 years. In year 3, his cash value was $142,000. He took a policy loan of $130,000. Within 10 days, he had the down payment for the building. His practice now owns the space he operates in. The rental income from the other suites is repaying the policy loans, and his cash value has never stopped growing. He told me last year, I spent 7 years building a number I couldn't use. I spent 3 years building something I could.
The wealth trap is not a personal failure. It is a design flaw in the conventional financial system. The 401k was built to serve the system. The banking system was built to serve the system. Nobody built a vehicle designed to serve you until Nelson Nash figured out that a property structure or life insurance policy could be that vehicle. If you want to understand the banking function, whose bank your money is serving right now, and how to reclaim it, download our free guide. Every dollar you spend passes through a bank. The question is, whose bank? The link is in the description below. If you are between the ages of 30 and 55 with a gross family income of $150,000 or more, visit infinitebankingsimplified.com to book your complimentary strategy call. We will show you exactly what your accessible capital picture looks like and what it could look like 12 months from now. Every dollar you spend passes through a bank. make sure it is yours. In the next video, I want to show you how people in your exact income bracket are buying rental properties and small commercial buildings without touching a single dollar of their retirement savings and without a bank approval. Subscribe so you do not miss it. We publish every week.